Picture this: Amsterdam 1602. Ships leave the harbor loaded with spices and silk. The profits could be huge. The risks are even bigger. Before this moment, people often funded one voyage at a time. Then a new idea appeared. A company that sold pieces of itself to many investors across many voyages. The idea grew into something we use today, the stock market. Before 1602, investors often backed individual trips. If a ship sank, everyone lost. If it returned, the backers got paid. There was no easy way to trade your stake after you invested. Capital tended to begin and end with each voyage. In 1602, the Dutch East India Company introduced a different model. It issued tradable shares and raised permanent capital for many voyages over many years. Investors could buy a small slice of the company and sell it later to someone else. Trading gathered in a central place in Amsterdam, widely considered the first form of stock exchange dedicated to company shares. Two key ingredients appear here. First, companies raise money from the public, and the second, investors can trade with each other. The model spread. In London, trading often happened in coffee houses before the market formalized into an exchange in the early 1800s. In New York, brokers signed the Bretton Woods Agreement in 1792, a step on the path to the New York Stock Exchange. Everywhere the pattern was similar. Gather buyers and sellers, set rules, let prices form in public. What changed the world was not just ships, it was scaling. A stock market does three things in simple terms. First, it lets companies raise capital to build big projects. Second, it provides price discovery so everyone sees where buyers and sellers meet. And third, it offers liquidity so investors can exit without waiting years. With those three pieces, railways, factories, and later technology could grow far beyond what a few private backers could fund. Markets are powerful, but they are not perfect. Excitement can outrun reality. History shows bubbles and crashes, and the lesson is simple. A stock market spreads risks and funds growth, but risk never disappears. Even if you never buy a share, markets affect your life. Companies raise money to hire and build. Pensions and index funds invest in shares on behalf of millions. Prices on exchanges feed into the economy. The modern market is digital and global, but the core idea is the same as in 1602. Pool money to fund big ideas. Share the gains and the risk. This is how the stock market began. In the next video, I will explain what the stock market is today in plain English so the moving parts make sense. If you like simple finance, subscribe and hit the bell. Question for you. Did you know this story started with ships and a share you could trade?